Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news, of course, with the only man that brings us the news is Nick Bendel. Hello, Nick.
Hello, Owen. How are you?
I'm pretty good. What's been happening with you?
Oh, what's been happening with me? I
It's
went
been a whole week.
Yes, well, yesterday I went axe throwing.
Axe throwing. Wow.
Yes,
And you're still with us.
I'm still with you, but the person I went with, he met an unfortunate demise.
Oh, okay. Well, I'm glad you didn't get blamed for it or caught, either one. Um,
No, so officially my story to the police was that it was an accident, and given that we're recording now, I will have to stick to that story.
Oh, okay, fair enough. We'll stick to that story. How about your work week? Anything interesting?
Yeah, the work week went well. I own a company called Hunter and Scribe, which is a content writing agency that writes content for brokers throughout Australia. And at the end of last week, one of the country's largest mortgage broking groups asked Hunter and Scribe if we would provide them with 6 to 8 blogs per month.
Wow, that's cool. Well done.
Well, thank you. That is very nice. Funnily enough, we've had a relationship with them, I think, for about 3 years.
Yeah.
I've done some stuff for them, and now they want to increase the amount of content, which is nice. They're very good to work with.
Wow. So they want to ramp it up.
They do indeed, because they recognize the value of content marketing, and who can blame them?
I certainly can't, and I'm sure you won't because it's what you do for a living.
Exactly. So no one is blaming them. They'll be pleased to hear that. How was your week?
My week was as usual, a busy one. We got more business coming on board. So getting a few properties leased. It's been interesting this year. It goes in waves of having a lot of properties on the market, and then a lot seems to get leased, and it's and then a lot more come on, and so yeah, it's interesting to see how the market is moving, and in different markets around the country. So yes.
Well, when I want to know what's happening in the rental market, you're the man I turn to, because your company, Leifield, is in 5 states. Most property managers, and this is not a criticism, most property managers are in just one market. You're in 5 states. You've got a good view of what's happening in most parts of Australia, not Norfolk Island, not yet anyway.
No,
But
not
you are
Norfolk
in
Island.
the 5 biggest states. And the reason I mention that is we are going to discuss the rental market a little bit later.
Oh, looking forward to that. And yes, thanks, Nick, for mentioning it. Yes, we are in Queensland, New South Wales, Victoria, SA, and WA. So with all the capital cities in those states, as well as some of the regional areas in at least two of those states, being New South Wales and Queensland.
Did you see that Trump has levied 10% tariffs on Australia, but 29% tariffs on Norfolk Island?
No, I didn't notice that. It's I did notice. I did hear about him putting tariffs on a couple of Australian territory islands that where the only population are penguins
Yes,
on
but
those
penguins,
islands.
penguins that export a lot of products to America.
Really? Okay. All right. Well, I'm not sure if anyone's interviewed the penguins to see how they feel about that, but yeah, but I'm interested to know what Norfolk Island um export to the United States.
Well, the answer apparently is nothing. I've read a couple of articles about it, so the locals are bemused. But this actually vindicates your decision, I think, not to expand to Norfolk Island.
Yeah, yeah, it's I know, because otherwise I'd have to put up my prices by 30%.
Exactly. On that note, shall we move on to our 3 news stories for today?
Yes, what's in the news, Nick? Hit me with it.
Well, our first story is Coalition promises to change mortgage buffer. The Shadow Housing Minister, Michael Sukkar, has announced that a coalition government will tell APRA, the banking regulator, to change its serviceability buffer, which is currently a minimum of 3 percentage points for all borrowers. Sukkar said, "We will make it clear that APRA must consider the impact of its rules on access to housing, particularly for first home buyers. That means reducing the overly cautious serviceability buffer, which was introduced when rates were near zero, but remains unchanged even as the cash rate sits above 4%. This one-size-fits-all rule is stopping tens of thousands of Australians from getting a home loan, even when they can meet the repayments with a prudent margin against unexpected future rate rises. That's not good regulation. It's a barrier to aspiration." Oh, and Sukkar didn't say what the new buffer would look like, just that it needs to be changed. What are your thoughts?
Um, Thanks, Nick. As you know, and some regular listeners might remember, I had a mortgage broking business for 12 years, and still work with a lot of mortgage brokers. So still have access to a lot of people in the industry. Just to clarify one thing, though, it mentions there in the article saying that the serviceability buffer, which was introduced when rates were near zero, remains unchanged. Now, just to clarify, um, there's always been a serviceability buffer, but the rate so the size of that buffer does change from time to time. And when when rates were very low during COVID times, there was a big push to be able to increase that buffer, to be able to make it because when rates start to drastically or dramatically increase, which they did, a lot of people got caught out. So they wanted to make sure that there was a big enough buffer in place for when people could, so to ensure that people could still afford their repayments when rates increased. So all they're saying now is, well, rates have increased quite a bit. Let's reduce that buffer and make it easier for people to be able to borrow because they can afford it, and we're not expecting rates to dramatically increase or decrease to any great extent at the moment. So yeah.
And should we have a one-size-fits-all buffer, or should it be lower for some borrowers and higher for others?
No, it should be one size fits all. It's because it's taking into account the the greater market. If they're wanting to say lower the buffer for first home buyers, they're probably the most vulnerable to rate changes, more specifically rate increases. So we probably need a bigger buffer to make sure that they can absorb any of those rate changes and increases. But that would be unfair. A lot of people would say to make it harder for first home buyers to get into the market. So and the same with investors. They're usually reliant on the rental income to come in to be able to make mortgage repayments. If anything happened to their rent, they would be, or if rents dropped, and which they can happen even in this current market in some areas. And so they would be more vulnerable as well. So to any rate increases. So it would really only be the second home owner occupiers, which is actually the biggest part of the market, the home ownership market, where that would be the easiest ones to lend to. That you could actually drop those rates for. So, yeah.
Well, okay, so you're saying it should be one size fits all, but let me push back on that. What about having a different buffer depending on the LVR. So maybe you have a higher buffer if someone has got a 90% LVR loan and a lower buffer at 70% LVR.
Yeah, okay, and that's would be that's effectively what I was uh, saying, where your investors and your first home buyers would usually have a higher LVR, and so that's where they're more vulnerable to, and as a result, higher loan amounts, and so that's where they would be more vulnerable. So, and then your second home buyers would usually have a lower loan amount with a lower LVR. So, yes, that would be the only case. And if you, I guess it would be fair to do it by an LVR standard. Yeah.
And what about changing the buffer as rates go up and down? So if rates were to fall a few percentage points, should we raise the buffer? Or if rates were to go up a few percentage points, should we lower the buffer?
Yes, but we don't want to, and I guess that's what they're proposing here, and it's or promising to make the change, because we've had rates increase and back to a more normal level, so there's not as much need for a larger buffer like when we had much lower interest rates. But it can't be at the same difference in what the average interest rate is. And so if you've got 2% interest rates and average interest rate is 7% over time, you couldn't have a 5% buffer. Otherwise, what's the point in having lower interest rates? It's so it would definitely have to be larger as rates are lower, and then a lower buffer when rates do increase.
Let's move on to our second story for today. Property market returns to record territory. Australia's median property prices climbed to a record $820,000 after rising 0.4% in March, according to Cotality, formerly CoreLogic. The national median price previously peaked in November 2024 after climbing for 22 consecutive months. It then fell slightly, but has now increased 0.7% over the past quarter. Cotality Research Director Tim Lawless said, improved sentiment following the February rate cut is likely the biggest driver of the turnaround in values, along with the cut's direct influence of a slight improvement in borrowing capacity and mortgage serviceability. With the rate cutting cycle expected to be drawn out, it will be interesting to see if this positive inflection in values can last in the face of affordability constraints. Owen, let me ask you about three different markets. But starting with Melbourne, Melbourne prices fell 2.6% over the year to March, but rose 0.3% during the March quarter. Do you expect Melbourne prices to be higher at the end of this year than at the start of this year?
Yes, I would definitely expect Melbourne prices to be higher at the end of this year. We're seeing a lot more demand coming into that market, a lot more purchases. We're seeing it within our business where we get a lot of business and referrals from buyers agents, and we're seeing a lot more interest in the Melbourne market from our partnered buyers agents. So as a result, they are being very picky on what areas and what types of property they're buying. So I don't expect it to be double-digit growth this year, but I definitely think that we'd be seeing an overall increase.
Well, Melbourne's been in the doldrums for about 3 years now, so it'll be interesting to see.
Even longer. It's pre-COVID, we haven't seen any decent growth out of Melbourne. Yeah.
So potentially there might be some catch-up growth in the years ahead, which is, I guess, what's happened in Perth over the past few years. And now, speaking of Perth, Perth has been booming for about 3 years, maybe a little bit longer. Perth prices rose 11.9% over the year to March, but only 0.2% over the March quarter. So has the Perth boom come to an end, do you think?
I definitely think it's slowed and slowing. And it's, yes, I would expect by the end of this year we'd be seeing single digit growth, and 0.2% seems very low. We've certainly seen a drop off in demand and activity from our buyer's agent business partners that had been buying in Perth, but there's still decent activity and demand in Perth.
Well, Perth prices went backwards between 2014 and 2021. I guess you could say Perth has maybe caught up all of that. And I guess time will tell how much more growth lies ahead in this cycle.
Yeah, it might have another 12 months, I think, but yeah, there's not a lot left in Perth, I would say.
And finally, let me ask you about Sydney. Sydney prices are 1.4% off their peak, which occurred in September last year. But the city is back in growth mode. Do you expect Sydney to record a new record high price at some point this year?
Wouldn't be surprised. It's all we need is one more rate cut, and that could fuel it. And it's just the demand that we're seeing out there in the market. On the weekend, I was out at Austral in southwest Sydney, which is near the new Badgerys Creek Airport. And the amount of infrastructure being built, the amount of houses being built out there is just huge. So, and yeah, the prices for those properties aren't reducing at all, and it will keep fueling that price growth in Sydney.
Well, we spoke earlier about the possibility of the coalition winning the election and what they would do with the serviceability buffer. If they were to reduce it, you'd expect that would lead to higher demand. I suppose there's also the possibility of a Labor minority government, and in order for Labor to get the numbers, they have to do a deal with the Greens, and maybe one of the things they have to give the Greens is removing negative gearing, or maybe having some sort of rental freeze or rent cap, which I guess might reduce demand. So it'll be interesting to see what happens in terms of who gets elected and what policies follow.
Yes, it will be interesting. Yeah, we've still got another 4 weeks of campaigning to go. Looks like there's been an anti-Trump, anti-tariff swing that's aided the Albanese government in this past week. But yes, if we were to have the Greens having any kind of power and influence with their ridiculous policies, especially when it comes to the property market, yes, that won't be good for our country. It won't be good for anyone.
Our final story today, rental market continues slowing. Rents are at record highs in every capital city, but rental growth has slowed to a 4-year low, according to Domain. Domain said, despite house and unit rents sitting at record highs across all capital cities, the overall pace of growth is easing considerably. Several markets recorded their softest March quarter in years. Seasonal strength typically buoys the first quarter, and all cities remain landlord-friendly with sub 2% vacancy rates. But growing financial pressure on tenants and a gradual lift in rental supply are helping to slow the pace. Sydney, Melbourne, Brisbane, Adelaide and Perth all saw a marked deceleration in annual rental growth, with most cities experiencing 5% or less annual change, a significant drop from the double-digit gains previously. So, Owen, Domain gave several reasons for the slowdown in rental growth, with one of them being affordability pressures. As we mentioned, you and Leifield, you're operating in 5 different states. Have you noticed that tenants are now tapped out?
Not quite tapped out, but yes, the rate of growth has slowed dramatically, and I don't think that's necessarily a bad thing. It's we saw dramatic increases in interest rates. We saw a lack of supply of rental properties. We've seen an increase in supply since in the last couple of years, and which has helped that um, uh, to ease the pressure on raising rental amounts. And as more stock comes on, we're going to be able to see that helps it even more. Yeah, it's if people can't afford to rent, I think what they're doing is they're moving to other areas where it's cheaper. For one example, in Sydney, for example, we see a lot of people moving from Sydney to some of the more surrounding regional areas, like to the Central Coast, even to Newcastle and the Hunter Valley. But what that does is it has a push on, say, Central Coast rental amounts, and then there's people on the Central Coast who can't necessarily afford to live there anymore, and they end up moving to either further north to Newcastle or out to the Hunter Valley to be able to get something cheaper. So it's people need to move further afield if they can to be able to afford less, or they move to something smaller and they downsize. So I think the market is just leveling itself off after the turbulent turmoil of the COVID years, where people were making a lot of decisions and moving out of the inner city to the burbs and regional areas. And there's been some movement back, as well as all of the massive increase in immigration coming into the country. So I think it's just a leveling off of the market, and the market is doing its job of leveling off prices where they need to be.
That makes sense. Domain said another reason for the slowdown in rental growth is that there's been an increase in investor activity, which has meant an increase in rental supply. Have you noticed that it's become harder for landlords to attract quality tenants?
Not so much quality tenants. It's there's not an issue there, but it's overall we're seeing the number of inquiries and the number of applications in total coming through dropping off on average. But there's still plenty of properties that get rented very quickly. So there's no issue with getting, if the property is priced properly, there's no reason why you can't get a tenant within 2 weeks, and with a number of applications to choose from. But we're talking like 3 to 5 applications to choose from, rather than 20 or 30 as we were looking at maybe 2 years ago.
Rents in the combined capital cities increased only 3.2% in the year to March. Can you foresee a situation in which rent started going backwards in the capital cities?
Yeah, there's no reason why they couldn't go backwards if there's enough supply to outstrip demand. And we actually see it in some micro markets, so individual suburbs where there is a lot of demand in those suburbs at the time. So that 3.2% isn't, it's not the same in every suburb. We've still got some suburbs that are increasing dramatically by double digits. And then there's others that are going backwards because there's an oversupply. And so that's how we level off with this average of 3.2%. So if there's enough suburbs with an oversupply, and yes, there's been a lot of increase in investor activity, especially in those lower price points, which is where we need them to be able to supply more stock for the rental market, to be able to help bring those rents down, or at least the rental growth down to a manageable level.
Now, just before we say goodbye, Owen, I'm going to ask you the question that I'm going to ask you every week during the election campaign, which is who's going to win. So last week, I predicted a minority coalition government. You were a little spineless and didn't predict anything. So I'm sticking to a minority coalition government. What's your latest prediction?
If anything from the past week, that's your prediction is looking less likely. It's and not that I'm ready to predict it in the other direction, but yeah, I'm going to say it's still too early to call. I'm sticking on that fence.
Okay, now I should tell you I was certain that Shorten was going to win in 2019 and quietly confident that Morrison would win in 2022. So my track record on these things is not very good.
Okay, well, maybe you shouldn't stick your neck out this time, Nick, and let's just see how it goes.
Yeah, I mean, if I predicted the coalition to win, judging by my record, I think Labor supporters can be pretty happy with that.
Yes, maybe. So yeah, let's maybe stop the predictions now, Nick, and yes, it's. I mean, there hasn't been a one-term government for since before our lifetimes. So yes, it would be hard to predict anything other than the Albanese government coming back in. Not that I'm necessarily pleased about that.
Well, can I predict?
We'll see.
Can I predict that we will be back next week with some more news and some more bad jokes?
I 100% guarantee that.
Okay, well, thanks for the chat and see you next week.
See you, Nick.